but also, you may surprise you, one of the top 5 mobile companies in the world, and now one of the most important data companies in the world. So I think there are treasure troves to be found even in the most seemingly traditional companies when you step back and look at them in a slightly different context. Obviously weather affects all of us. It affects as people, it affects us as consumers, and the ability to be geolocated, micro-targeted. These things are obviously good for the consumer, but also good for the advertiser in the same process.
Right. Well, I've talked to these companies that are buying up these and asked them precisely the same question: how do you kind of justify those kinds of investments, whether it's Disney or DreamWorks, and you get this same answer, which is basically, look, they are not 100% sure, but they do know that these assets could be vehicles to create new franchises, and there's a whole host of potential opportunities to monetize such assets, whether it's kind of, for example, DreamWorks has talked about trying to build a kind of a media channel of some of the assets that are seated there that potentially have yet to be exploited. Disney as well. And when you think about it strategically by paying the kind of prices they're paying, I think it's easier to perhaps justify today. Because my sense is these companies are willing to step up more and bid for these assets because the opportunities to leverage them across various platforms is something that's not readily available to international buyers. So that's why you're seeing more competition in some of these kind of small type deals for these kinds of assets. If you look at Awesomeness TV or even some of the other, the viewership has been phenomenal, and these companies have been able to kind of even grow the asset further. DreamWorks, for example, how they deal with Hearst. Recently, the value of Awesomeness TV, kind of the 25% stake of $80-something million, which is several orders of magnitude higher than what they paid for the asset. And you look at the numbers and see why they invested in it, even though they're making very little money. And as an analyst, you have to look at that and say, how do you justify that and what's the upside? And quickly realize that this is a long-term play.
I think it has to do with the audience. You mentioned millennials. An example I always use is you should go to VidCon, which is kind of a big conference for all the YouTube space. And last time I was there, there was I'll not name the celebrity, but there was a real big Hollywood celebrity with his entourage, like 10 people. No one cared. Like, not a single person walked out and asked for something. And then the Fine Brothers, two YouTubers, walked past, and then you saw 200 screaming young girls running past. And I almost wanted to go and ask them, how does it feel? Because I'm sure the celebrity was expecting something else. So I think that is a little bit the fear of what happens to this young demographic millennials that spend all the time on YouTube, or if they're male gamers, they spend hours on Twitch. And so that's time that they don't spend consuming the traditional media channels that parents would experience or consume. So I think it's a little bit of that. They don't know how to reach these people.
And you don't want to lose that generation.
Yeah.
Right. That's good. So Harris, while coming over to you, you introduced yourselves as kind of strategic venture capital. So tell us a little bit about what that is, a little bit more about why that's driving a bit of the deal flow as well, and the emerging technology deal flow. With that.
Sure.
Scott, as well.
So I think generally you see there was a lot of corporate venture free in the bubble space, and I think that down quite fast. If you now look at the last couple of years, I think the last 3 years there's something like 500 new corporate VC units were created in the last 3 or 4 years alone all over the world. So it's definitely a trend that is happening, that big corporates want to find a venue or a vehicle that can bring some innovation into the big parent company. And I think we're just one tool of a big tool set of what a big company can do to be innovative. It's still strategic investing, they do acquisitions, but they also do corporate venture capital. So what we do is we invest early, we behave like a normal VC, but we make sure that we link up our portfolio companies with our parent company. I give you the example, Starhall, one of our portfolio companies, we run a large YouTube MCN Indian fashion space. And after we invested, we make sure that they have a production deal with Freeman. But it's not, of course, these things. It's like, you make your own introduction and you take both sides, take the meeting and are very positively exposed when they meet. But it's, it still has to make sense on an individual level to make those deals. So we hooked up Starhall with Fremantle. We made sure that all the other television executives knew about them, we met them from time to time. And then at some point, I think we had them in our portfolio for 18 months, and then RTL decided to buy them. So it's a rare opportunity. It's the first time a company in our portfolio ended up being acquired by a parent company. And so we were not set up for that, because then you have different mindsets. You have M&A, who on corporate venture, you behave differently. And if you think, no, this is about helping portfolio young startups and bringing some innovation to a parent company, then you behave a little differently. We sold 9 companies in the last year alone, it's only one ended up. So it's really the rare case. And then very often I get the question, so did they have any special rights, mention rights, something like that? And we don't do any of that. It was a very normal arm's length transaction. It was bank involved, make sure that there's no funny business happening. And I think that's just one of the ways how we add value. So the parent company got to know Starhall for 18 months, and by that virtue of that, they formed an opinion whether they like it, which is sometimes easier to do that over 18 months than if it's like an M&A team and to do it in 2 months. And also, some of the other things is that we do for our parent companies. We organize trips. We make sure that we funnel interesting startups to our parent company, which, by the way, the startups love. So we visit them, they talk about for funding, and we introduce them to our book division, we introduce them to television. So I think it's a great value add. And my view on the venture space in general is that you have to have a special sauce going forward. If you're just redistributing money from LPs to direct investments, there's a risk of being disintermediated by something like AngelList or something like anything like that. So I think our special sauce is we know the space that we invest in quite well. We think that we can be quite helpful with making introductions. And that's, I think, why people like to spend our money.
Scott, why are ventures, it seems like increasing, corporate ventures and capital venture funds?
I can't think of all the corporate ventures on there, Kenny, but certainly it's, as I sort of say, when you set the corporate venture fund, you really, or the venture fund aligns with the company, you really need to pick your focus, and you need to have what you put value on the table. Like we are very much specialists in the digital media world. We know extensively how the TV business works, how the movie business works, how the video business works, how the publishing mobile ad tech works. We don't spend time in fintech, we don't spend time in e-commerce, we don't spend time in hardware secondary business. A lot of areas that we see investments we don't look at. Because we really find we want to be in these areas, we want to be in areas that we think can help drive the business in the company. Certainly operators across all of our divisions are always looking for innovative ways to increase the business as well. But they also manage large P&Ls, big and for us, this is our day job. We meet with over 500 companies a year. And it's our business to know everybody who's engaged in it. If you're running CNN.com, big P&L, you may not have time to do the bandwidth to really do something. And most times people see CNN, you see people like these reports, people from HBO, and we try to spend a quarter of our time just interacting with all these people, making sure that they know what we're seeing, making sure we know what's of interest to them, so we don't know what we're on. But also, we want to ensure that we're not looking we want to really look kind of midterm take, people that do years out, what will be more. Now, in terms of my other companies that grow their corporate venture groups are good in the sense that A, it helps foster innovation because you form a great relationship in the space. And B, if you're doing it right, you're making money. So it's not as if we're cost center, corporate, generate real cash, certainly helps with the budgeting process. And you know, it's something to pay for ourselves, and it's a good way to keep everyone abreast on the space. If you do it that way, you can always set up R&D groups, you can always set up more people, you know, vision, more distributed manner to help innovation. We've seen that in other companies, and it's generally hard. Hard because they don't generate cash themselves, and when tough times come, they may be the first one. So, and I think a lot of companies in the trenches, what media is a traditional business, going through a lot of construction, you know, the automotive space is a traditional business, going through a lot of handful of those. It's a good way to keep on top of things. It's a good way, again, to
So you mentioned what's interesting to Aaron or to yourself. What are the areas that you and in that role are looking to invest in? What are the more interesting areas that you're saying?
So,
And just also areas that we will compare that to sort of Matt and Mike were saying in traditional banking.
So one of the big areas of interest is the rapid change we see in television advertising. How can television advertisers, how can television inventory oversights in turn, how can we increase the value of our own TV? How can we manage our own TV inventory with third-party data sets to show exact graphics and graphics who's watching, and to show attribution who watching TV ads and other kinds of action. And to show that the value is higher relative to say where it's social or it's digital. Well, not higher because will the TV landscape become more like a digital online mobile activities? Very interesting areas. We have new investments in the space. Lots of digital change. In addition to this, we do spend a lot of time in the over-the-top video space. Everything from the infrastructure and the plumbing to make sure that you have good experiences. Streaming video over the top, which is not trivial means, but then everything from aggregator content to content recommendations to UI and experience. People are going to be watching more over the top video than less, and there's a lot of problems to solve in that stack as we continue to move forward with investments. The last item we spent a lot of time in is how do we understand more about our end users? Time Warner is traditionally some current grids of traditionally been as vehicles and package up TV shows, movies. We sell them to distributors like Comcast or Movie or Netflix, who then goes and sells That's not through our website or apps, through other touch points. That's not going to be the case now. We can know a lot more about our consumers. So how do you get more information on consumers? How do you understand what their interests are? How do you personalize content for them? How do you market to them directly? A lot of interesting innovation coming out of the ad tech world. So we've been investing in that as well.
For us, we have three sectors that we invest in. We also consider ourselves very highly focused. And every couple of years, we sit down and analyze those things, those ventures about returns to those categories, and if we at some point decide, no, we'll take one of those topics out and add new ones. We always want to be focused. One that we spend a lot of time on is very similar to Scott's, that's why we run into each other in real all the time, is online video. So we call that the next gen TV. So it's a lot of online video. It's on YouTube, off YouTube, it's the plumbing, it's video ad tech. All those topics we spend a lot of time in. And to be honest, the thing has been quite good to us. We sold Drama Fever and Star Hall in the last couple of months, so that's two exits alone, and then we invest some of those proceeds into that topic. So on a business way, second sector that we invest in is what we call PubTech, publisher technology. It's all the B2B stuff to that publisher or mobile publishers. So ad tech definitely is a big part of that, but we didn't want to just call it ad tech because we wanted to go a little broader. So there's a content recommendations companies like Surfman, or there's gaming solutions like the D-Show, which I see the logo right there. So it's B2B things where we are a potential client, or we know all the other clients and we can help you get some of those. So that's why we invest in them. And then the third sector that we currently spend time on is what we call next generation content community commerce. So those are either next-gen publishers like the Trade that was sold a couple weeks ago. I mean, one of our companies that we invested in is Mike Media. Obviously, Mike is how they started here in New York. Double Eagles, Food 52. Those are all players that have a little different angle than if I look at how my own magazine publishing unit attacks those verticals. So it's either it's a site from millennials for millennials, or it's something like Food 52, which is a wonderful community site. They have great content, also tutorial content, and then they also start selling things, so they have an e-commerce component to it. So in a way, it's good to have something like if you're only dependent on patterns, it might be interesting to also have a transactional relationship with some of your audience. So that's kind of, those are the three topics that we currently spend on. So we, 2 years ago, kind of said no to gaming, no to music, which is, we all love gaming music, but there is a benefit of being focused and knowing 30 people to call when you see a deal and on the you versus having to learn it yourself.
So now we've heard about how potentially corporate venture is looking at something different than traditional money. So maybe you can talk about what you're doing or Bain's doing.
Sure. Well, I can speak to Bain Capital as an advertiser. So our companies are a very significant advertiser, both in the U.S. and globally. And Bain Capital Ventures actually, which is, touches the space closer to where you guys play, is perhaps another good point in. On the private equity advertising front, I would say the biggest thing that we see is there's a re-empowerment of the advertiser. And, the leverage in many ways has come back to brand money that's been, somewhat imperiled in many ways over the past decade or so. I would say that there has been a re-empowerment of the advertiser. You were mentioning, brands as media companies. I think it's pretty accurate. If you step back and sort of normalize an impression value, I think a lot of brands are realizing that, hey, you know what, if we make an investment in content, it may actually pay greater dividends and be more, of a recurring benefit to us than through traditional paid advertising. That doesn't always mean that the traditional media companies are cut out of the loop. I would say, Canada Goose, which is one of our companies, actually partners more directly with Sundance and TIFF and others to actually get closer to the content in film. Tom Shoes, which is sort of been built from a very ground up, socially strong perspective. They I would say embrace content creators even more directly, more deeply than I've seen some of our paid advertisers do in the past. On the venture side, a lot of the theme has been around marketing infrastructure, and whether it's Kenshu or Jet.com, it's been interesting to watch advertisers regain control of that marketing infrastructure, which has been so intermediated over the past decade that I think they lost a bit of control over where their dollars and their data were traveling before they arrived at media companies. A lot of that power and the leverage of the dollar spent has been regained, which is a really interesting trend to us.
Do you see a trend at all towards more partnerships as opposed to investments, acquisitions, venture? That's something that we see increasingly with the media companies.
It's always part of the
Right.
companies in particular, also Berlin, Advance, so they've been quite active. But I think it's important to sort of mention before when we invest in or whether we invest like an agencies that we make sure that there's a clear delineation between our money coming in as investors and it not being tied to any interest entity. It's not saying, great, we'll give you $5 million on a 43, but you have to give us free access to your product on all our divisions. Or we have a right to buy in 3 years for a certain price, or we right of first refusal. It's a very dangerous thing to put in as term sheets. It's very short-sighted. Once you start doing that enough, no other investor will want to play with you. Or as strategic, us, and then we'll bring one of our traders from our partners. And, if that partnership goes well, maybe in the future we'll invest.
The biggest mindset I've seen over the last decade or so, as far as strategic acquirers, I think there's been a paradigm shift away from the kind of quote-unquote mega deals, with the exception, of course, of gas time. But I think you're now seeing a lot of these companies more trying to do relatively small deals, $100 million, couple $100 million range. I have to say that it's not for lack of liquidity. A lot of these companies are seeing out of cash. News Corp, for example, I'm sorry, Fox, for the first century has not upwards of $10 billion cash to be waiting to be deployed. Yet they're doing a lot of companies, share buybacks, modern dividends, Disney, over $5 billion. I mean, these are not extremely high levels like technology company standards, but like historical standards, I think there is ample liquidity. There's a lot of dry powder there, but you sense that the companies are a little hesitant to pull the trigger on any kind of major deal for a variety of reasons. I think that's kind of a different mindset that we saw prior to the financial crisis. So clearly there's been more deal making in areas where the companies have generated new revenue streams, whether it's kind of retransmission percent, for example. We've seen intelligence station deals kind of accelerate, coming out of the recession. But in terms of the mega blockbuster deals, I think the corporate folks are really held to much more accountable. And that's why I think they will step up when the deal is right, and all the evidence of what you guys are talking about, relatively minimal investments with potentially significant upside. So that's the paradigm shift.
I was going to say, you're seeing more deal flow in the last year and a half because of the debt markets. So where a company may have otherwise decided to think about partnering, they said, why don't you just buy the company relative to partnering? Oftentimes, they move more from partnering to acquisition where it's core competency, they need to own, they want to own, they need to scale, it migrates from a partnership to acquisition. But you're not going to see somebody like Uber or Spotify who partner with them to deliver Spotify in their cars. That makes sense. It makes sense for Uber to acquire somebody like Spotify. So partnerships, there's a thought process that goes into should partnership be acquired. But at the end of the day, in a situation where you've got very attractive debt markets, if you own events, I think companies will be more inclined to make an acquisition. If the debt markets will shift and it becomes more expensive to buy companies, I think you'll see companies partner more often.
One thing to add there, that you asked about which way more investment, more partnerships, or convention. I think, at least for my own perspective, I think people a lot more in all of these. So I think there are more joint ventures, more partnerships now than I've seen 5-6 years ago. I don't know if you talk and say how it is in this company. I think our company needed, they were less active 5 years ago. But now it's a little bit of demand for advice, for the food channel. So I think it's something that might not have happened 5 years ago. I think at least my friend of the world is more isolated. You can do it all like this. I don't know, at least a little bit my observation.
I would say also on the acquisition side, in certain sectors are more aggressive than others. Media has not been as aggressive. The biggest one today was 65 acres. But in the tech space, Facebook, very aggressive, spending real money on WhatsApp, spending real money on Oculus, and it has no revenue. But also, Facebook is a very fast-growing company, even faster than media. So they have rapid growth, they have a huge amount of cash, not high currency where they're trading, and they're able to make these kinds of acquisitions. It would be tough for a media company to spend $18 billion on one investment. It would be crushed. Yes, I'm not a minority. But for Facebook, it went very well. They need to continue to grow. And that's what we're doing.
Or even what's dealing on Twitch, which is a product I have. I had one studio, college studio, and tell me, at the show, they present it like that. You get tired of Twitch, but great acquisition for, for the company, but it kind of illustrates the dynamics of, having some of these deals, when it gets to a certain threshold, potential bureaucracy that can impede, corporate filers